is AST SpaceMobile, ticker symbol ASTS. Is it currently a falling knife throwing off massive sell signals? Or is it, a radically undervalued strong buy just waiting to explode?
Welcome to another deep dive. We are pulling apart the raw market data today. But before we get into the charts, do us a quick favor. Hit the like button, subscribe to our YouTube channel, and absolutely leave your feedback in the comments. We scour those comments to figure out what you want us to investigate next, so your input directly shapes the show.
Yeah, exactly. The more you push back on our analysis or suggest new angles, the sharper the next deep dive becomes. So definitely drop a comment. Right. So here is our mission for you today. We have this massive stack of current market data, technical indicators, financial reports, all from right now, April 2026, to unpack exactly what is happening with ASTS. We are dissecting the incredibly conflicting signals surrounding this stock and really debating whether it's a dangerous value trap or a genuine opportunity.
Yeah.
And just to be perfectly clear up front, we are here for educational purposes and, a natural human debate. This is not financial advice.
Right, definitely not financial advice. We are just analyzing the psychology of the market and the mechanics of the trade based on the data we have available. How you allocate your portfolio is entirely up to you.
Absolutely. So let's set the scene with the raw numbers. We really can't dive into the technical chart indicators until we understand the fundamental news that is driving this stock's erratic behavior right now. So as of the market close on April 23, 2026, the stock is sitting at $78.75.
Which is a pretty rough day for them.
Yeah, to put it mildly. That represents a really sharp 6.98% intraday drop. So they're down $5.91 in a single session, though I will say it did creep up just slightly in after hours, trading to $79.50.
Yeah, but that intraday drop, that is entirely catalyst-driven. Like a 7% drop on a random Tuesday might just be algorithmic noise, right?
Yeah.
But in this case, we have a very specific structural catalyst that really spooked institutional buyers.
Spooked is probably putting it mildly. We are looking at a massive collision of news here. The bearish catalyst, the reason for the immediate drop is a major satellite launch failure. AST SpaceMobile actually lost their BlueBird 7 satellite when the Blue Origin rocket carrying it failed.
Yeah.
Right. And that failure has triggered this immediate 30 to 60-day delay in their entire deployment timeline.
Well, and the thing is, in the broader scope of the aerospace industry, a 60-day delay is it's practically a rounding error.
Yeah.
The stock market does not operate on an aerospace timeline.
No, definitely not.
Right. The market operates on quarterly expectations, and it absolutely hates uncertainty. A rocket failure introduces this massive unknown variable. So the algorithms just immediately price in the worst case scenario. Like, what if the next 3 rockets fail too?
Yeah, the timing of this is what makes it such a fascinating case study. Occurring almost simultaneously with that rocket failure is a massive, highly anticipated regulatory win. On April 22, 2026, literally the day before the drop, the FCC officially granted ASTS the authority for U.S. commercial operations.
Which is huge.
It's massive. It's like getting your official driver's license on the exact same day your car's engine explodes.
That is a great way to put it. And, that tension between the short-term execution risk and the long-term structural advantage, that's exactly what's driving the current volatility. Day traders and these momentum algorithms, they see the headline, launch failure, and immediately hit the sell button.
Right, panic selling.
Exactly. And in their rush to exit, they are completely discounting the massive long-term economic moat that's created by that FCC approval.
Well, let's pause on that concept of the economic moat for a second, because the satellites aren't fully deployed yet, right? The one they just tried to launch blew up. So why does a piece of paper from the FCC matter so much to the long-term valuation if the actual hardware isn't functioning?
Because spectrum rights and regulatory approvals act as the invisible infrastructure of the global telecommunications world. You could theoretically build the most advanced, high-tech satellite in human history, but if the Federal Communications Commission does not legally permit you to transmit commercial signals down to smartphones in the United States, your satellite is literally just a billion-dollar piece of space junk.
So it's basically permission to print money, assuming you can get the hardware working.
Precisely. Securing that U.S. Commercial Operations Authority essentially gives ASTS a geographic monopoly. They unlocked the legal right to generate revenue in the most lucrative telecom market on Earth. It is a barrier to entry that, frankly, no competitor can simply buy their way through overnight.
Yeah, but the market clearly doesn't care about invisible infrastructure right now. They just see a blown-up rocket and a delayed timeline. I mean, a 30 to 60-day delay means 30 to 60 days of paying salaries, maintaining facilities, and, building hardware without bringing any new commercial satellites online.
Right, and that brings us to the core anxiety of every single space-based company, which is the cash burn rate.
Let's open up their 2025 financial statements because that timeline delay puts an immediate stress test on their balance sheet. Looking at the income statement, 2025 was the year ASTS officially transitioned into a revenue-generating company. Total revenue hit $70.92 million.
Which is a huge milestone for them.
It is. To put the scale of that transition into perspective, their 2024 revenue was just $4.4 million.
Yeah, transitioning from purely theoretical research and development to actually generating over $70 million in revenue is, it's a proof of concept that the market demanded. It signals that the underlying direct-to-cell technology actually functions at scale, and more importantly, that telecom clients are actually willing to pay for it.
But the bottom line is a very painful story. Net income for 2025 is negative $341.94 million. That results in an earnings per share of negative $1.34, and that massive loss is driven by incredibly heavy R&D and launch costs.
Which is to be expected, but still hurts to look at.
Yeah, and moving over to the balance sheet and cash flow, total assets are sitting at $5.01 billion against total liabilities of $2.62 billion. Operating cash flow is negative $71.5 million. But the number that really jumps off the page, like grabs you by the throat, is capital expenditure.
Oh, yeah, the CapEx.
CapEx is negative $1.06 billion. Spending over $1 billion in a single year on CapEx sounds, honestly, absolutely terrifying. Is this burn rate a giant red flag, or is it just, I don't know, the mandatory cost of trying to build a telecom network in low Earth orbit?
Well, you really have to separate a company like ASTS from a traditional software or retail stock. I mean, if a software company has $1 billion in CapEx, you run away fast.
Right.
But building a space-based telecommunications network requires front-loading just a colossal amount of capital before you see a single dollar of profit. That $1.06 billion isn't vanishing into administrative bloat. It is being converted directly into highly advanced proprietary hardware. It represents the physical construction of their massive folding satellite arrays. It's simply the cost of entry for participating in the modern space race.
$1 billion entry fee is steep, though. Can they actually afford to keep playing the game, especially with the 60-day delay we just talked about?
This is where their financial engineering becomes really crucial, because despite that incredible burn rate, their cash runway is unusually strong. Right now, the balance sheet shows roughly $2.8 billion in cash and cash equivalents. But you have to look at the pro forma numbers to get the full picture.
Can you break down pro forma for us in the specific context? How are they getting a different number than what's strictly punted on the balance sheet?
So pro forma accounting essentially says, let's look at the present moment, but adjust it for events we know have already been finalized. In 2025, ASTS successfully raised over $3.5 billion from various institutional offerings. When you factor in the capital that has been secured but was, still settling or allocated for future tranches, their pro forma cash position actually expands to around $3.9 billion.
Wow, $3.9 billion in cash. That is an enormous war chest.
It fundamentally changes their risk profile. That $3.9 billion means they are fully funded to complete their current constellation of satellites. There is no immediate panic about running out of money next quarter.
The launch failure is just a hiccup.
Exactly. The 30 to 60-day delay from the Blue Origin failure is a bump in the road, not a death sentence. They do not have to go back to the public markets hat in hand, issuing new shares and diluting current investors just to keep the lights on.
We also checked the insider activity to see how the executives are reacting to all this. And despite the rocket exploding and that massive billion-dollar CapEx, there have been 0 major insider sales reported in the last 30 days. The C-suite and the board members are holding their shares.
And that's telling. When executives hold their equity through a high-profile crisis, it is a very strong signal. It implies the people with the deepest visibility into the engineering data and the corporate strategy really believe the long-term thesis remains intact.
Okay, so the fundamental picture shows a company burning cash like a furnace, but sitting on an even bigger mountain of cash with executives who aren't panicking. But, fundamentals don't tell you how traders are pricing in the immediate risk. To understand the psychological battle happening right now, we have to look at the technical analysis and the chart signals.
Yeah, and the technicals are currently painting a drastically different picture than the fundamental balance sheet.
Let's start with the extremes to understand the sheer scale of the volatility. The 52-week high is $129.89, which they hit back on January 30th, 2026. The 52-week low is $22.07 from exactly a year ago, April 30, 2025. And the stock has a beta of 2.81.
That beta is wild.
Right. Now, for anyone unfamiliar, a beta of 1 means a stock moves in lockstep with the broader market. A beta of 2.81 means ASTS is extremely volatile, swinging almost 3 times as wildly as the S&P 500. This stock isn't just riding a roller coaster, it's strapped to a rocket.
And right now, unfortunately, the trajectory of that rocket is violently downward. Short-term weakness is glaringly evident across almost every momentum indicator we look at. The stock is trapped in a falling channel, currently trading at $78.75. That puts it significantly below its 50-day moving average of $89.05.
Yeah, and the 50-day moving average is a crucial psychological floor for short-term and swing traders. Breaking below it usually triggers an automatic bearish signal for a lot of algorithmic trading programs.
Right. It forces a massive shift in momentum. But the MACD paints an even bleaker picture for the immediate future.
The MACD, the moving average convergence divergence, is sitting at negative 1.28. Let's unpack the mechanics of that real quick. The MACD isn't just some random number. It measures the relationship between 2 moving averages of a stock's price, usually the 12-day and the 26-day. When the shorter-term average drops below the longer-term average and the MACD goes negative, it is a textbook sell signal.
Yeah, it physically measures that downward momentum is accelerating.
Exactly. Traders look at a negative MACD and just assume the selling pressure has not exhausted itself yet. But we have to look for where the historical buyers might step back in. We have to map out the support and resistance zones.
So on the way up, key resistance sits at $81.31, which aligns with the daily trend line, followed by a heavier ceiling at $85.06. That is where sellers have historically overwhelmed buyers. And on the way down, key support is at $77.58, and the critical one-month low of $71.85.
The silver lining for long-term holders here is that despite all the short-term pain, the macro strength remains intact. The stock is still trading above its 200-day moving average, which is currently sitting at $72.48.
And that's key, because institutional investors use the 200-day moving average as the ultimate line in the sand. As long as the price holds above $72.48, the multi-year upward trend is technically still alive.
The battle happening between that $78 price point and the $72 moving average is just vicious right now. We pulled the indicators and the options market data because the options chain is where you really see how the big money is manipulating the battlefield. Let's start with the RSI, the Relative Strength Index, which is at 34.11.
Right, so the RSI measures the speed and magnitude of recent price changes. An RSI approaching 30 suggests the asset is entering oversold territory. It mathematically implies the recent wave of selling might be overdone, which can often trigger a mechanical bounce, as short sellers buy back shares to take their profits.
But the order flow in the options market shows why everyday investors are getting chopped to pieces trying to play that bounce. We are looking at a tightly range-bound battle. There is massive open interest at the $75 dollar, put over 12,070 open contracts.
A huge wall.
Yeah, and on the upper side, there is massive open interest at the $90 call, with over 13,443 open contracts. How can retail traders even survive being caught in this vice between the $75 put and the $90 call? It looks like a trap designed to bleed everyone's premiums dry.
That is exactly what it is. You were describing a concept called max pain. Market makers are the institutions writing these options contracts. When you have massive open interest walls like that $75 put floor and the $90 call ceiling, the market makers have a vested financial interest in keeping the stock pinned squarely between those two numbers.
Because if it stays in the middle, the contracts expire worthless, and the market makers just keep all the cash retail traders paid for those options.
Precisely. To remain neutral and protect their own books, market makers engage in delta hedging. As the stock drops towards $75, they start buying the underlying shares, creating artificial support. As it rallies toward $90, they start shorting or selling shares, creating artificial resistance.
So the price just ping-pongs in a tight channel.
Yeah, exactly. If you are a retail trader trying to guess short-term direction in that environment, you are essentially gambling against the house at a casino where the dealer controls the cards. The volatility just crushes the value of your options.
The technicals are screaming sell. The options market is a meat grinder built by institutional market makers, but what do the Wall Street analysts actually say?
This is where the paradox of AST SpaceMobile becomes incredibly apparent.
The Wall Street consensus is a buy. Out of the major analysts covering the stock, we have 6 buys, 3 holds, and only 2 sells. The median price target is $86.40. But look at the extremes here. The most bullish analyst has a high target of $137, while the most bearish has a low of $41.20.
That massive spread between $41 and $137 exposes a fundamental truth: nobody actually knows how to accurately value this company in the present moment. Traditional valuation models are just completely breaking down.
Which brings us to the core debate of our analysis. With analysts flashing buy, but technicals screaming sell, is ASTS a deadly value trap for retail traders, or is it a fundamentally undervalued giant? Let's break down the bear case versus the bull case.
The bear case, the argument that this is a value trap focuses heavily on the systemic risks and the valuation multiples.
Let's start with the operating expenses. In the fourth quarter of 2025 alone, their OPEX was $126.6 million. Even with a $3.9 billion cash buffer, burning over $100 million a quarter makes risk-averse investors sweat, especially when launch timelines start slipping.
And traditional value investors look at the valuation metrics and just run out of the room. The stock currently trades at a trailing price-to-sales ratio of roughly 950x.
950 times sales. I mean, a Benjamin Graham or Warren Buffett-style value investor would throw up looking at that multiple. You were paying $950 for every $1 the company generated in revenue last year.
Yeah, for a mature company, a 950x BS ratio is an absurdity. The bears argue that this astronomical valuation prices in a level of flawless execution that ASTS has not yet proven capable of delivering.
The worst-case scenario for the bears hinges on the ongoing Blue Origin investigation. What if that rocket failure wasn't just a freak accident? If the investigation reveals deeper, systemic issues with how the BlueBird satellites integrate with the launch vehicles, that 30 to 60-day delay could easily spiral into a 6 to 9 month blackout.
And that dynamic creates the classic retail trap. Retail traders see a stock that traded at $129 a few months ago, now sitting at $78. They think, oh, it's a discount, I need to buy the dip.
But they step in to catch that falling knife before the technical channel actually reverses.
Exactly. They buy purely based on the historical price, completely ignoring the downward momentum in the high beta. They don't wait for key support levels like that 200-day moving average at $72.48 to actually hold and prove that institutional buyers have returned. They let impatience drive their portfolio, and they get crushed when a stock that is down 40% drops another 20%.
The technical trap is very real. But consider the alternative. Let's look at the bull case. Why do those 6 analysts have a buy rating? The core argument is that despite the 950 XPS ratio, the stock is actually deeply undervalued relative to its intrinsic potential. Forward-looking models suggest an intrinsic value of $225 per share.
That's a massive upside.
Right, but that valuation relies on one massive assumption: their planned 248 satellite constellation succeeds.
That assumption carries a lot of execution risk. But the math behind the $225 target is rooted in a very tangible reality regarding their partnerships.
ASTS isn't trying to build a new consumer brand from scratch. They aren't trying to convince people to buy a clunky, specialized satellite phone. They have established inked partnerships with massive telecom giants like AT&T and Verizon.
This is the mechanism that bulls focus on. Through those AT&T and Verizon partnerships, ASTS instantly gains access to nearly 3 billion global subscribers, and the technology works directly with standard, unmodified smartphones.
So if they successfully deploy the constellation, they essentially flip a switch. Suddenly, they are providing dead zone coverage and generating high-margin, recurring revenue from a significant percentage of those 3 billion people, all routed directly through the carrier's existing billing systems.
When you model out the cash flows of a monopoly-like space-based telecom provider that has a captive audience of 3 billion potential customers, a $225 share price starts to look conservative. The bulls are entirely ignoring the 950x trailing PS ratio. They are not valuing ASTS on the $70 million it made last year. They are valuing it on the multi-billion-dollar cash printing machine it could become in 3 years.
It all comes down to the friction of execution. They have the most valuable digital real estate on Earth thanks to the FCC, and they have the customers lined up thanks to AT&T. But they don't have the hardware fully built and deployed yet.
They have the blueprint and the permits, but they need to finish pouring the concrete.
Let's synthesize this massive debate into a clear timeline outlook for you before we wrap up.
If we weigh the financials, the technicals, and the news catalysts, the short-term outlook is firmly bearish to neutral. You should expect heavy, sustained volatility to continue. The options market makers are trapping the price, the algorithms are reacting to negative momentum, and the market still has to digest the outcome of the Blue Origin satellite launch investigation. In the short term, the technical trend dictates the reality.
But the medium to long-term outlook remains distinctly bullish. The market's memory is short. Eventually, the focus will shift away from the BlueBird 7 failure and pivot toward the massive block of 45 to 60 satellite launches planned for late 2026. Once those new launch dates solidify, the narrative will inevitably swing back to the telecom revenue potential and that FCC moat.
It is a textbook case of short-term headline noise, temporarily masking a long-term structural signal. The question is whether you have the discipline and the strategy to ride out the noise.
And whether you have the capital to survive a potential margin call if the 200-day moving average breaks. We've mapped the technicals, we've untangled the pro forma financials, and we've debated the reality of the value trap versus the $225 intrinsic target. But as you continue your own research, I want to leave you with one final thought to mull over. We talked about the brutal math of their success. The models require a full 248 satellites in orbit to justify the massive upside, but they just lost BlueBird 7. Every lost satellite burns through that pro forma cash runway. So the real question isn't just about the technology working, it's about endurance. How many more launch failures can that $3.9 billion cash buffer actually absorb before the financial math completely breaks down?